As the U.S. markets are closed for the weekend, SoFi Technologies, traded under the ticker SoFi, concluded its latest session on Friday, September 5, 2025, at a price of 25.6. This represented a modest gain of 0.87% for the day, a figure that, on its surface, seems unremarkable. However, that simple closing number masks a dramatic intraday struggle, with the stock experiencing a wide trading range between 24.18 and 25.97 on the back of over 71 million shares changing hands. This volatility is the real story, and it hints at a profound tension surrounding SoFi's identity. The expectation sold to the market is that of a revolutionary, high-growth fintech disruptor, a one-stop digital shop for every financial need. But the reality, reflected in these daily battles between buyers and sellers, is that the market is grappling with a much more complex question. Is SoFi a nimble technology company deserving of a premium valuation? Or is it fundamentally a bank, shackled to the less glamorous realities of interest rates, credit cycles, and regulatory oversight? This identity crisis is the single most important factor driving the stock today, and understanding it is the key to unlocking where SoFi might be headed next. The common belief, and the narrative heavily promoted by the company and its most ardent supporters, is that SoFi is building an unassailable financial services productivity loop. The idea is that a customer initially drawn in by one product, perhaps a student loan refinance or a high-yield savings account, will inevitably be pulled into the broader ecosystem, adopting SoFi for investing, credit cards, insurance, and more. This ecosystem, powered by a sleek digital interface and its proprietary technology platforms like Galileo and Technisys, is meant to create sticky, high-value customer relationships that justify a valuation far exceeding that of a traditional brick-and-mortar bank. The latest earnings report from Q2 2025 certainly fed this narrative, showcasing record member growth to 11.7 million and a 43% surge in year-over-year revenue to 855 million. The company even posted its seventh consecutive quarter of GAAP profitability, with net income soaring an astonishing 459% to 97.3 million. These are the headline numbers that fuel the expectation of a fintech juggernaut in the making. However, a deeper analysis of the recent market action and underlying financial metrics reveals the cracks in this high-tech facade. While revenue growth is impressive, the market is increasingly focused on the quality of that revenue. A significant portion of SoFi's income still stems from its lending division. This reliance on net interest income, the classic banking spread between what it pays on deposits and earns on loans, exposes it directly to the whims of macroeconomic policy. The current global economic environment, marked by persistent inflation and the potential for slowing growth, casts a long shadow over any lending-dependent business. Even a slight uptick in personal loan delinquencies, a metric analysts are watching with hawk-like intensity, could significantly impact profitability and force the company to increase its provisions for loan losses. The stock's recent choppiness reflects this anxiety. Days of strong gains on positive market sentiment are often erased by sharp downturns following any hint of economic weakness or a more hawkish tone from central banks. This is not the trading pattern of a pure-play technology stock. It is the pattern of a financial institution being reevaluated in a challenging economic climate. Institutional activity further complicates the picture. While major players like Vanguard have increased their positions, signaling long-term confidence, the overall analyst consensus has settled into a lukewarm hold. Price targets are wildly dispersed, with bulls like Jefferies setting targets as high as 30, while others remain far more conservative. This divergence highlights the deep division in how the so-called smart money views the company's core identity. Those who believe in the technology and ecosystem story see a path to significant multiple expansion. Those who see a bank in fintech clothing are wary of the valuation, which, with a P/E ratio north of 50, is rich for a traditional lender. They see the potential for credit quality, deterioration, and net interest margin compression as significant headwinds that are not being fully priced in by the more optimistic wing of the market. The high trading volume, averaging nearly 75 million shares daily, is evidence of this ongoing battle, with long-term growth investors accumulating on dips while momentum traders and macro-focused funds actively trade around economic data points. To be clear, SoFi is not a traditional bank. Its business model is a hybrid, built on three core pillars. The lending segment, its largest revenue generator, offers personal loans, student loans, and mortgages. The technology platform segment, which includes Galileo and Technisys, provides the core digital infrastructure for other banks and fintech companies, a promising, capital-light, and high-margin business-to-business revenue stream. Finally, the financial services segment is the consumer-facing ecosystem of products like SoFi Money, SoFi Invest, and the SoFi Credit Card, designed to capture the entire financial life of its members. The bull case hinges on the latter two segments growing to a point where they overshadow the lending business, fundamentally transforming the company's revenue mix and justifying a tech valuation. The recent announcement of the SoFi Agentic AI ETF is a clear strategic move in this direction, signaling an intent to be at the forefront of financial innovation. Comment below on whether you believe SoFi's technology and financial services segments can outgrow its lending arm within the next 3 years. Looking forward, the path for SoFi is fraught with both immense opportunity and significant risk, all framed by this central conflict of expectation versus reality. The primary catalyst for the bulls is the continued successful execution of the cross-selling strategy. If SoFi can demonstrate that its massive member growth is translating into deeper, multi-product relationships, it will validate the ecosystem narrative. A continued string of profitable quarters, particularly if driven by growth in the higher-margin technology and financial services segments, could force a re-rating of the stock. Furthermore, a more stable and favorable macroeconomic environment with lower interest rates would act as a massive tailwind for its core lending operations, easing pressure on margins and credit quality. Conversely, the risks are stark and heavily tied to the banking side of its identity. A recessionary environment would be a severe test of its underwriting models, and any significant increase in loan defaults would hammer profitability. Intense competition from both incumbent banks rapidly improving their digital offerings and a swarm of other fintech startups presents a constant threat to member growth and market share. Finally, the regulatory environment for financial services is ever tightening, and any new rules around capital requirements or lending practices could increase compliance costs and crimp growth. In conclusion, the story of SoFi Technologies is far more nuanced than a simple closing price of 25.6 might suggest. The market's expectation is a seamless, high-growth journey to fintech dominance, powered by a superior digital platform. The reality is, a company straddling two worlds, navigating the volatile intersection of technology and banking. The exceptional growth in members and revenue is real, but so is the underlying sensitivity to credit cycles and interest rate policy. The daily fluctuations and high-volume trading are not random noise. They are the market's real-time debate over the company's fundamental nature. The ultimate trajectory of the stock will depend not just on growing its user base, but on fundamentally shifting its revenue dependency away from traditional lending and proving, once and for all, that the reality of its diversified, tech-forward ecosystem can finally and decisively overcome the market's expectation that it is, at its heart, just another bank.